So the standard deduction for seniors went up to 18,150. Regular standard deduction for 2020. Good question. Yeah, 2025. I was like, just making sure. 2025 is 16,100, right? So that's $16,100 you don't pay taxes on your federal return. And for seniors, that goes up to 18,150. And to be considered a senior, you do need to be 65 years of age or older. Now, and also the standard deduction went up to 16,100. So if you're married, both of you get $16,100 you don't pay any taxes on. Now, you want to itemize if you have a home, you're paying mortgage interest, property tax, because you can get over the 16,000 super fast alone with mortgage interest and property tax. So you do want to utilize those. All right. And while we're talking about itemized deductions, we should talk about SALT cap. So in the 2017 tax law changes, the government limited state income tax deduction to $10,000. And that's for whether you're single or married, right? So what does that mean? A lot of married couples, a lot of single couples that own homes. So you could be a married couple or a single person that owns a home. You were losing out on a lot of deductions on your itemized deductions from 2018 to 2024, sorry. So now that means, hey, if you have $20,000 of property tax that you pay, you can take the full $20,000 deduction. It's not limited to 10. Why? Because that cap went up to 40,000, which is great. This is really going to help a lot of people in California, New York, and basically states where property taxes are really high. And Texas. So Texas, for example, has no state income tax that they charge you, but their property taxes are really high. So in those 3 states, I saw a lot of my clients lose deductions, and we had to strategize and see where they can make up those deductions. Now, let's say you do have 20,000, 25,000, because on top of your property taxes, you can add vehicle property taxes. You can also add your income tax, property taxes. So let's say you hit 30 just with that alone. That's a really good deduction, which is why people itemize versus taking the standard deduction. Again, I always recommend people to itemize if they're homeowners. If you're not a homeowner, then you take the standard deduction. And it's $16,000, and $16,100 you don't pay taxes on, right? All right. Now moving along to businesses, because I'm always going to talk about individuals and businesses in terms of the tax tips. So starting January, owners will be able to expense out, January of 2025, owners are able to expense out 100% bonus depreciation. So bonus depreciation is amazing. 100%, what does that mean? So usually if you buy a truck, I'm just going to give an example of a warehouse. They buy a truck, right? And they want to expense it for the year, but they can't because here's the thing, the truck costs $60,000, $80,000. You want to expense the $60,000, $80,000, whatever the amount is, all in 1 year. The way depreciation works is that a truck has a life value, just like any other assets in your business. The truck, you don't use it up in 1 year and you're done. You don't never use a truck again. The truck has a life value that the IRS has assigned to it, as well as furniture, laptops, computers, and stuff like that. Everything has a different life class that the IRS has assigned to them. So what does that mean? Technically, the IRS says the car is good for 5 years and then it loses its value, right? So they'll give you a deduction for the next 5 years for that truck because you're using the car up every single year. If more than likely, a lot of businesses don't pay cash for it, so it's not like they're gonna pay that $80,000 in 1 year. However, some companies do choose to buy a car outright. So what does that mean? If you spend $40,000, $80,000 in one year to buy a truck, you want to expense the whole thing out, right? You want the $80,000 deduction. However, with depreciation, you can't. You have to spread it over 5 years. Now, with the 100% bonus depreciation, that allows you to depreciate the $80,000, meaning get the $80,000 of deduction in the first year that you're using the car. Now, if you get a loan and you owe the truck, well, that's different. You're gonna pay the truck off in the next 5 years. However, you accelerated the deduction and you took the full $80,000 in the current year. So I encourage you to discuss with your accountant if that's a good strategy for you to take or not, because remember, now you're using up the $80,000 in the first year. So what are you going to do for the next 4 years, right? There's no deduction there. So there is times where as an accountant, I will decide to not take bonus depreciation. And that's because me and my client are planning that we need that deduction in the next years. So again, discuss that with your tax guy, right? All right. R&D expensing. Okay, so yeah, that not that many companies use it, and I don't want people to kind of get stuck on, oh, I can use R&D research deduction. And there's a lot of documentation that is involved in that credit, and there's tax firms that only specialize in that credit. So can I request that credit for you as your tax guy? Yes. Am I the best person to do it? Probably not. I don't handle this credit year to year, day in, day out. You want to go with someone that's an expert. It's a lengthy process to collect all the documentation, and very few research actually qualifies for it. Like you just can't say that, like, you traveling to like this other country involves like research, right? So it's very particular, but yeah, I won't spend more time on that one. Retirement contributions, right? So if you can max out your retirement contributions as a business owner or as an employee, right? I would recommend for you to do that. So 23,500 is the max that you can do for 2025, and 2026 as well, I believe. Don't quote me on that, because if it usually goes up every year based on inflation, but I can also find you the actual numbers. I would say that if you can do it, this is the time to do it. So, kind of arriving to the end of our tax tip. Get ready for tax season, right? It's January. Start collecting all your documents now. Yes, ask your accountant to get you an extension. I get all my clients extensions automatically because there's so much documentation that gets sent to them. Their business income and expenses needs to be reviewed not once, twice, or 3 times. Things need to be verified. 1099s need to be sent out before the end of the month. W-2s as well. So gather your documents now, right? Right now is the time for you to get all that documentation in place and review your records. But most importantly, too, if you're not a business but you're an employee, right? And this is the time to adjust your W-4. People change their W-4s all throughout the year, and you can change that every day if you wanted to, but who's crazy enough to do that? What I would recommend is if your situation changed, like let's say, unfortunately, this is a very common situation. I have clients that get divorced, and then the next year comes up and they never change their W-4 information at their employer. In their employer, they're still being taxed as if they're married and have 2 dependents or have 3 or 4, whatever the amount is. Now you need to update that, because when you go do your taxes in 2027, in 2026, now you're single, you don't have any dependents, you should have gone down in the amount of dependents you have at work. Yes, that means you're going to get taxed more. But, I always tell people, the tax that you owe on W-2 income should come from your W-2 income. Why are you owing this at the end of the year just so you have more money in your pocket throughout the year? Look, unless you're going to invest that money somewhere in the stock market or have financial advisors do like extremely great with it, most people won't. And I'll sit here all day long and tell you like, hey, like, great for you. You know how to do research on the internet. But I can guarantee that you didn't take those extra withholdings you took out and invest it in the stock market and made more money. Most people just take that money and then spend it, or because they need it. No, it is better to not owe at the end of the year when the taxes are due, because at the end of the year, if you owe, now you're going to owe with interest and penalties. Throughout the year, if the money's taken away from your paychecks, you're paid on time, right? Your employer pays your taxes for you. So I feel very strong about that. I've been doing taxes for 15 years. I see people all the time owing on the regular W-2 income that they make. Now, if you owe money on like 1099 or additional income you make or investment income, all right, you didn't plan properly the year before that to pay those taxes. However, you can plan moving forward, right? So it is January. Talk to your tax guy. Let's get something on the books, where you can meet with them. Most of them are more than happy to meet with you. I would much rather meet with my clients, in the beginning of the year, even if it's for 15, 20 minutes, to be like, okay, how's your W-2? What's this? And then you proactively are planning, and it's for the next year, right? Because 2025 will be, or has been, over at this point. So you can't go back and do anything for 2025. December 31st is the final day you can do anything for tax year 2025. So now we're in 2026. I need you guys to start acting proactively. And yeah, it's not that hard. Talk to your accountant. If you have a good one, they'll explain to you in detail like what you should be thinking about. And it could be as simple as a 5-minute conversation. But yes, thank you guys for listening to another episode of Tax Tips with Latinx Business Podcast. Remember that we offer an initial consultation for a fee. We'll review your tax documents and last year's tax returns, both for personal and for business clients. And then it's a no obligation fee, which means if you don't want to become our client after that, then you can go off and do your own taxes. You utilize that full hour to like ask me all your questions. I'll rather educate you so you're like a well-informed like taxpayer. I always say my job is to educate you. You guys make the decisions moving forward, following the tax law, of course. No, I mean, guys, really, it's January, the beginning of the year. Get your questions asked. Pay a consultation fee to your tax guy. It's well worth your time. In our office, we actually apply it to your tax bill when we're done completing your tax returns for the year, if you choose to become our client. So it's a win-win situation for you. You get your money's worth. And, on our end, we also spend a valuable hour of our time with you. And then we're all happy. So yeah, guys, thank you for tuning in again. It's January and I hope to hear you soon. I was gonna say, send me your tax questions. So if you guys want to hear a quick tax tip, or if you want to know like, hey, this is my situation, maybe on the next episode, I'll bring it up. And then it'll be like the case example that I use to talk about. And then I think it would provide a very rich experience for all of us, especially for you guys, right? If you get to hear your tax situation on one of these episodes. But all right, guys, thanks so much. Talk to you later. Bye.